This week on the Retirement Quick Tips podcast, I'm talking about how to keep your focus and your nerve amid market chaos. Now, every day this week, I'm sharing with you some thoughts, ideas, tips that work for some people. Like some people are going to be like, oh, okay, I just need to look a little bit less in my portfolio in order to feel better. Okay, I can do that. So certain tips and strategies will work well for some people and not for others. And that's why I'm trying to share with you a variety of different ideas, things that I've implemented over the years with clients in times of market and economic chaos. And sometimes just making a small little tweak helps you take back control. I talked yesterday, like, don't let a dead person beat you at investing because that's what happens a lot of the time. Because we love to buy high and sell low. I guess what I'm trying to do this week is just give you different things where it's like some things are going to resonate with you, some things aren't. And one of the things that has really resonated with me a lot over the years is when I was a little baby advisor, when I first started out, I worked in a pretty large office. There was like 25 other advisors. Side note, every month they would post what your revenue was. And because I was brand new, I was always at the bottom. And so it was really fun because everybody got to see how well everybody did that month. And if you were at the bottom like me, and you were a 22, 23-year-old advisor who had like 0 clients, it didn't look too great, but it's a humbling experience. So one of the advisors in the office had this giant poster and he had it framed. It's from the Investment Company of America Fund, which if you're familiar with American funds, this is like their flagship fund. Like American Funds is a huge mutual fund company. This fund, their flagship fund, started in 1934, which is amazing. Like for a mutual fund to have a track record that long, it just doesn't exist. Because even ones that have been around for a long time, they don't last this long. So this thing has like almost 100-year track record now. It's like 91 years. By the way, this is not a endorsement for the fund. But American funds, what they do is they update this chart every year. You can look it up. It's the Investment Company of America. That's the name of the fund, but it's their mountain chart. And I think that's the name. It's super boring. But what it does is it overlays the performance of the fund across this 90-year time period. And then what they do is they show the events that happened, typically negative events that were, headline news that were driving the markets that year. I just want to go back to 2007 and I'm going to read every one year by year. And I picked 2007 because it was the year I started as a financial advisor. And also it was like right before the Great Recession. And my point in doing this is that every time when something happens, we think, oh, the sky is really falling this time. It's going to get really, really bad. We're headed to another deep, dark, Great Depression. And although the circumstances and what causes recessions and shocks and market chaos, those things are always changing. And so in a sense, like every time there's a downturn in the market, every time there's a recession, every time, your portfolio drops in value, every time it is a little bit or a lot different. But the way the markets react and the stock market reacts to that is actually pretty predictable. Like most of the time, the big, bad, scary events of the world don't have this huge negative impact where they send the economy into a recession. We have a bear market. It goes down 25, 30, 40%. Yes, that does happen, but it doesn't happen very often. The stock market, although seemingly mysterious, is at any given time, basically what it is a cumulative value of all of the largest publicly traded companies in the US and around the world. It basically represents, like, on the whole, what are investors willing to pay for all the businesses today lumped up together based on all the available information and the future growth potential of those businesses. And the market, for all of its craziness on a daily basis, it is amazingly efficient, especially over a longer period of time, like a year, 5 years, 10 years. That it rewards the best companies. They get rewarded the most with the best returns, and the worst companies, they eventually just wash out, get acquired, like forgotten, they go bankrupt. Like those values are based on real events and the economy. But sometimes it's very easy to get caught up just in thinking about the current economy, who's in political office, like who's running the country, who's not running the country, especially right now. Like I find what I've noticed over the last year is that if you like Trump or you don't like Trump, that really colors your pessimism or optimism. Like that's what determines it. If you didn't vote for Trump, you are pretty pessimistic right now. I would bet money on it. And if you did vote for Trump, you're still probably pretty optimistic about the economy. And so there's not a whole lot in the middle. My point there is that there are always reasons to believe that this time is going to be different. But I'm here to tell you that this too shall pass. And whether it's tariffs or a slowdown in the economy or stagflation, we'll get through it. It could be a little while, and it does certainly impact the markets. But let me just rattle this off. 2007. So I'm just going to list every year the one thing that was kind of dominating the headlines that year that was driving markets. And we'll see that like it's still just, it goes up. Time marches on. Even though there's downturns, we get through it. We keep going, and this too shall pass. The circumstances every time is a little bit different, but it's usually not the game over scenario that's easy to kind of fall into that. So 2007, subprime credit crisis. Then 2008, U.S. recession. 2009, U.S. unemployment tops 10%. 2010, Gulf of Mexico oil spill. 2011, European sovereign debt crisis. U.S. faces a fiscal cliff in 2012. I remember that actually. Year 5 of federal government's quantitative easing policy. That was in 2013. Then in 2014, we had the conflict in Syria. 2015, a Greek debt crisis and China's growth starts to slow. 2016, a wave of populism affects elections around the world. 2017, hurricanes pummel the U.S. and Caribbean. A U.S. trade war with China started in 2018. Then we go into a bit of a trade war and global rates are cut in, interest rates are cut in 2019. Then, of course, 2020, who could forget COVID? 2021, inflation surges, not just here in the U.S., but around the world. 2022, then we have the Federal Reserve ramping up interest rates to fight inflation. That was painful. 2023, we had the Israel-Hamas conflict begins in October of that year. Then in 2024, Bank of Japan raises interest rates, triggering a market sell-off. So of course, there's always reasons not to invest. But over that time period, you have about what was the cumulative level? I go back and look at the Dow or the S&P 500 in 2007 and fast forward to today. It's absolutely staggering. And we've had a lot of turmoil. I mean, that includes the 2008 financial crisis, COVID, everything in between. All right, that's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.